So learning objective 4 comes after all those adjustments we were doing, right? We spent learning objective 2 and learning objective 3 learning the adjustment process for deferrals and accruals. And there were 7 of them in total. So again, everything we put into the journal will travel, right? We'll post into the ledger account, which means that now our ledger account balances are different in those accounts. And so that means we actually have to do another trial balance. But since we're doing the trial balance after those adjustments, we call it the adjusted trial balance. Okay. So if you see the word adjusted trial balance, that's the trial balance after the adjustment process that we went through. So we just did all those adjustments. Now we have to check the balances. Adjusted trial balance is what we're doing. Okay. So this is important. This is important to know. This is the adjusted trial balance for Sierra Corporation after we did all those adjustments. Woohoo! We did 7 different adjusting entries, and many different accounts were affected. The accounts that are affected are shown with balances in red ink here. The accounts that have not been affected because they weren't part of the adjusting process are still shown here, but they will have black ink showing their balances there. So if you notice, there are many different accounts here that went through the adjusting process because there are many different accounts that have red numbers next to them. The first one that has a red number is the account of accounts receivable. Accounts receivable went through the adjustment process. Learning objective 3, in an accrued revenue, we need to have an accounts receivable listed for our service revenue that we wanted to claim. So remember, an accrued revenue basically is we've already done the work, but we haven't recorded it or we haven't billed the client for it. So what we have to do is make sure that we put that revenue earned in that period of time. So here we had to go ahead, this is for Sierra Corporation, as you remember, we had to go ahead and put in an accounts receivable for $200 so we can put that money in our revenue, in our service revenue account. That was the first one we did in learning objective 3. And so this is how these 2 accounts are affected, and so you'll be able to see that. You also know from doing the adjusting entries, the supplies account was adjusted. Right? How is it adjusted? Well, down here with supplies expense. So you'll see supplies expense, that balance is in red, just as supplies, that balance is also in red. Not because it went through the adjusting. It's a deferred, it's a deferral. It's a prepaid expense, right? Supply starts as an asset, but when we use it, we expense it. Same is true with prepaid insurance. Prepaid insurance also shows here as an adjusted account. Why? Because we had an insurance expense that we could take, right? Again, it's another deferral. It's a prepaid expense, meaning it started as an asset, but once we used it, we can expense it. So you will always have an insurance expense paired up with a prepaid insurance, right, on an adjusting entry there. Equipment is not affected, but accumulated depreciation for equipment is, right? And how is it affected? Well, because we took a depreciation expense. So this was also in learning objective 2. We have a depreciation expense, but we do not credit the equipment account. Instead, we credit the accumulated depreciation for equipment account. Okay. It is an account. It's listed right underneath the equipment account in this case. And it tells us how much of this equipment we have expensed through depreciation so far. Again, it accumulates over time. So the number will get bigger and bigger and bigger over time. The next account you see that was affected is Interest payable. Well, interest payable is an accrued, that was an accrual. We wanted to take the interest expense for that month of October and but also show that we will pay that later. That's the interest payable. So interest expense and interest payable, those two accounts go together in this process. We have unearned service revenue is also affected. Well, remember, unearned service revenue is a liability showing that we owe the client whatever work they paid for. So at the end of a period of time, in this case, the end of October, we're checking to see if we actually earned any of that. Right. So unearned is a liability, but once it's earned, it's service revenue. Service revenue is earned. You've already done the work. You've earned it. Unearned service revenue, the customer pays you up front and you owe the customer the work. So at the end of every period, you're going to check to see if you've delivered any work to the customer. And if so, you're going to reduce your unearned service revenue and you're going to increase your service revenue. Take it out of the liability, put it into the revenue account. The last thing you see here is the salaries and wages payable is affected. Why? Because we adjusted our salaries and wages expense, right, to show that. So all of these numbers that are shown in red simply are there to show you how they're linked to the adjustment process we went through. Notice that some accounts, those accounts have changed. And so once we do an adjusted trial balance, we are listing the new balances in each of these accounts. And thankfully, they balance. Okay. All the accounts with debit balances equal all the accounts with credit balances. So we're good. Now again, it's the adjusted trial balance. It's done after the adjustments. Yes, question.
If there was a buildings account, would accumulated depreciation for equipment come after equipment or after buildings?
So buildings would have its own accumulated depreciation account, just like equipment has its own accumulated depreciation account. So those would have their own accumulated depreciation accounts together, to answer your question.
So each accumulated depreciation account comes right after the account that it's for?
Yeah, that's correct. Yeah.
Thank you.
Yeah. Sure. So the good news is once we actually have the adjusted trial balance done, this is exactly what we use to prepare the financial statements for the business. Okay. This is what we use to prepare the financial statements for the business. So again, the very, very first, and I think the most important one, we always start with the income statement. It's the only statement that tells us whether we had a profit or a loss for a period of time, right? It's the first one that's done, and that's why the adjustment process emphasized making sure all the revenue is there and all the expenses are there, because this statement is the very first one. That if we get this right, then it flows from there. Where does it flow? It goes to the retained earnings statement next, and then that flows into the balance sheet. Okay. So from the adjusted trial balance, and I'm sorry, these are pretty small. The very first financial statement that we do is the income statement. This is the income statement for the month ending October 31st. Remember, the income statement is subject to the periodicity assumption because it measures a period of time. I mean, so does the retained earnings statement as well. But income statement is the very first one that we do. What goes on an income statement? Revenues go first. Service revenue account, where does the number come from? It actually comes from the adjusted trial balance. Okay. We use the adjusted trial balance to do our financial statements. Back when you were doing them in learning in chapter 1 and chapter 2, they were just giving you the numbers. But if you really needed to know where the numbers came from, you would look in the ledger, or you would look at the adjusted trial balance, and the balances would be there. So here we have the revenue account, service revenue of 10,600. So that's goes, it's the only revenue account we have. So that total can go into the far right column. Expenses are listed next. All of these expenses come right out of the adjusted trial balance. From salaries and wages all the way down to depreciation, they're listed in that order here. The total expenses are listed in the far right. So we had $7,740 in total expenses. Our revenue is 10,600. That's good. Why? Well, because that means we made a profit when revenue is bigger. Right? So $2,860 is our profit. We call it net income, right, on the income statement. We can also call it earnings, right? Because earnings, profit, net income all mean the same thing. We're all talking about the same thing. So that's the profit for this period of time, for the month ending October 31st, 2017. Okay. How confident can we be on this calculation? Very confident, because look at all the adjusting entries we had to do to make sure our revenue and expense accounts were up to date before we did this statement. Okay. So we can be very confident that this statement is done well. What's the next thing that happens? Well, the very next statement in line is the retained earnings statement. These are our earnings. How much of these earnings are going to be retained? That's what it tells us. Again, it's subject to the periodicity. It follows the exact same time period as the income statement because it tells the story of what happened to the profit on the income statement. How much of the profit is retained? How much of it was sent out as a dividend? Sierra Corporation is a brand new corporation. It just started. So retained earnings has a zero balance because it does not, this is a brand new company. It did not have any previous retained earnings because this is the first time an income statement's been done. So the beginning balance October 1st is zero. We add in the net income that we calculated on the income statement. So that gets added here. We take away the dividends. Where do we know where the dividend, how much dividends were paid? Well, that's we look at the adjusted trial balance. We see they paid $500 in dividends. So we subtract out the $500 in dividends. That means that our ending retained earnings, the ending balance on October 31st in retained earnings is $2,360. Okay. Who owns the earnings? The profits of the company, stockholders. So this will be put on the balance sheet, right, under stockholders' equity as retained earnings. Now, I want to bring up one more thing before I stop. The ending balance for October 31st will be the balance for November the 1st, beginning balance. Then we will add the profit for November, subtract out the dividends for November, and we'd have a new retained earnings balance at the end. So this keeps recycling. Okay. The ending balance for one period is the beginning balance for the new period. And it just keeps going from there. The third statement we do is the balance sheet, right? And the balance sheet starts with assets. Remember, look at the balance sheet is only a day. The balance sheet is not subject to the periodicity assumption because it doesn't measure a period of time. It only measures the assets, liabilities, and equity as of a day, right? It's a selfie. It's a selfie. It's what it looks like that day. Okay. Assets are listed first in the order they would be on a classified balance sheet. Current assets are listed first, like cash, receivables, supplies, and prepaid insurance, followed by, in this case, the equipment account minus accumulated depreciation for equipment. All of those accounts are usually listed first in the trial balance because they would be listed in first in the ledger. All these accounts come from the ledger. Okay. Total assets, 21,910 total assets. Those are all your current assets. plus the book value of your equipment, right? The book value of your equipment. So if your assets are total 21,910, so do your liabilities and equity. Well, let's find out. Liabilities are listed first. All your liabilities are right here, from notes payable down to salaries and wages payable, and all the amounts are given to you here. So you pluck it off and you put it right here. Total liabilities are 9550. For stockholders' equity, the common stock is given to you. But the retained earnings, this is only the beginning, right? You're not going to use this for your balance sheet. You're going to use the retained earnings statement to update the retained earnings account. This is simply the beginning balance. The ending balance was on your retained earnings statement. So stockholders' equity, common stock is 10 grand. Retained earnings, you calculated as 2360 from the previous statement. Don't forget that. Total stockholders' equity, 12,360. Add them together, bada boom, bada bing, 21,910. Your balance sheet balances. Amen, hallelujah. Perfect. Okay. So the big thing you need to know here is in the first part of this learning objective, the adjusted trial balance is the trial balance that's done after the adjustments. The adjusted trial balance is the place we go to get the numbers to do our financial statements. The income statement is always done first. Those numbers get taken right from the adjusted trial balance. Then our retained earnings statement is done. Then our balance sheet is done. That's the way we would do it in real life, okay, as well. This particular example doesn't do it exactly the way I'd like them to, but I didn't write the book. This company was just started on April the 1st, and it prepares a quarterly report, which means, or it doesn't do a monthly report, it does a quarterly report. A quarter is a 3-month period. So this is all of April, all of May, and all of June. So at the end of June, which is June 30th, those are all the accounts with debit balances listed here. These are all the accounts with credit balances listed here. Their adjusted trial balance clearly is balanced. Okay. Then they want you, A, to basically determine the net income, which means we need to do an income statement. We'll do that first. B is they want you just to give total assets and total liabilities. And again, that's where I disagree. Right. I'd rather you should do the whole balance sheet, but this just wants total assets, total liabilities, so we can do that. And the last thing this question wants is what's the retained earning balance at the end of June? Okay. So that's good. So first things first, the income statement. This company has 2 revenue accounts. And this company has 6 different expense accounts. So you need to know that to build your income statement. Your revenues would total 15,000. That's the 2 revenue accounts here added together. You would list all your expenses in the first column. The second column gets your total, 12,510. So this company had a profit of $2,490 for their first quarter. Nothing to write home about, but it's better than the alternative. So that was part A. I would have preferred you do a formal income statement. Part B asks you to determine total assets and total liabilities. Well, when you look back at this, you'll know here are your asset accounts, right? So you have cash, receivable, prepaid rent, supplies, and equipment. But if it has equipment, you also would know that would have accumulated depreciation on the equipment. Accumulated depreciation on equipment has a credit balance, right? Because that's how we get a book value. So we need to know the total assets there. So those are all your assets: cash, receivables, supplies, and prepaid rent. Equipment less accumulated depreciation for equipment will give you the book value of the equipment. You add all your assets up, total assets were 23,350. They only wanted to know the total liabilities for June. So again, when you go back to the trial balance, your liabilities are right here: payable, 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 unearned revenue. All of these are liability accounts. So you would list the liability accounts here in the order you saw them, and then the total liabilities for 7,460. Now you know what the balance sheet equation is. Assets equals liabilities and stockholders' equity. So here are your total assets. Here are your total liabilities. You can figure out what the stockholders' equity is because you can simply subtract those two to find that out. What they wanted you to do is to find out retained earnings. So let's go back to our adjusted trial balance here. Retained earnings balance starts with a 0 because it's the very first time the company is doing a report. So we need to know that. We also need to know about dividends, right, for retained earnings statement. So we're going to need to know that information as well. We're also going to need to know what the net income was. And once we know that, it's relatively easy. Beginning retained earnings are 0. You add your profit of 2490. You take away your dividends of 600. And your ending retained earnings, 1890. This is what's going to go on the balance sheet if we did it the proper way. Okay. So that is the first part of this of learning objective 4 that I wanted to do with you today. Zach, you have your hand raised. Yes, question.
Sorry, that was from before. I'll put it.
Oh, okay. Sorry, I get confused. I'll put it down. All right. So, any questions on that?